Good afternoon, everyone. On behalf of the Council of Real Estate, welcome to this special presentation of Dynamics of Growing Economies in Asian Countries, featuring members and special guests of our Asia Pacific CRE chapter. Thank you for joining us. I am Hiroisobe CRE, the 2026 APAC chapter chair. The Council of Real Estate is a distinguished solution-focused consortium of accomplished advisors addressing real estate challenges worldwide. Experienced, innovative, principled, and credentialed problem solvers, counselors reside in 22 countries, practice in many more, and offer expertise in 60 real estate disciplines across all asset classes. Each has earned the prestigious CRE designation. Let's recognize the sponsor for this event, Equus Capital Partners. Thank you for your sponsorship. Before we begin, we'd like to offer you a free digital subscription to the Councilor's peer-reviewed professional journal, Real Estate Issues. It has been named one of the top 10 essential real estate publications in the United States. Please visit the URL of cre.org/REI to subscribe. In today's APAC webinar, we will focus India to assess the real estate market, legal systems, and economy of one of the most growing countries in the world. Please note that this session has been pre-recorded due to time zone constraints. Now, let me introduce today's moderator, Mr. Yasushi Kinoshita, CRE. Yasushi is currently the Vice Chair of the CRE APAC chapter and a member of Economic Advisory Council in CRE. Yasushi, would you start the session, please?
Thank you, Hiro. So I'm pleased to introduce our two distinguished panelists for today's discussion on Indian real estate. Dr. Prashant Das is an associate professor of real estate at the Indian Institute of Management, Ahmedabad. He also serves on SEBI's Hybrid Securities Advisory Committee, the body regulating the REITs and InvITs in India. So he sees the market from both an academic and regulatory vantage point. He has taught at Harvard and UC Irvine, sits on the board of the listed developer Arvind Smart Spaces and American Real Estate Society, and holds a PhD from Georgia State University. The second panelist, Mr. Masatoshi Matsuo, is the founder of Genkai Capital Management in Japan, which he established in 2006, specializing in value-add strategies across offices, retail, residential, hotels, and healthcare real estate in Japan. He has built a cumulative track record of over $4 billion US. Most recently, he has turned to real estate securitization in Japanese regional markets while expanding into India. He's a graduate of University of Tokyo and holds an MBA from Wharton. So between them, we have the Indian regulatory academic perspective and the Japanese cross-border investors view. An ideal pairing for today's conversation. Please join me in welcoming them. So let's get started. The first, we like to have Prashant to start his presentation. So please start. The Zoom is yours, Prashant.
Thank you, Kinoshita-san. Having studied real estate in the US, I'm aware of the contributions CRE has made to the industry. And I'm very excited about this opportunity to present the case for India to the audience. I will focus on 5 opportunities in India to watch for. I will try to maintain objectivity as anyone else. I love my country. But My aim here is to give an unbiased perspective on foreign investment in Indian real estate markets. And I'm sure Kinoshita-san will do some balancing act to keep things in the right perspective. So I assume you can see my screen. And let me build some case for why India and why now. In full disclosure, I do not represent the government, and I'm not here to market India. I'm just here to present some exciting opportunities. India is, among the top growing economies in the making. Although the per capita statistics are skewed to the left in terms of income, when you look at the sheer size of the middle class of India, it's humongous. And sometimes national level statistics can be misleading because markets almost for any product is quite segmented. And India does offer a very big market and it's growing fast. There are around 400 million middle class consumers in India. That is around 90 million households. And in terms of purchasing power parity, their income would be anywhere from $10 to $100 per day. So we have a decent population in India, which has an appetite for goods and services. And the government has been budgeting a lot in the capital expenditure. That is nearly 3.1% of GDP. And there are some real estate products also that qualify as infrastructure. It's roughly around 115 US billion dollars being spent by the government on infrastructure. And we have a thriving REIT market. So the first REIT was introduced in 2019. Now we have, if I'm not wrong, the sixth REIT, which has already been listed. All REITs in India must be listed. And it has ushered a new era in commercial real estate markets of India. So how can foreign capital enter India? Here are the ways. The first is foreign direct investment. And earlier, it used to be more difficult. Around 2 decades ago, the government started changing the regulation to attract more foreign capital for direct investment. Since then, there have been some improvements in the regulation, learning from the experience. We will discuss them later. But you can take direct equity exposure to construction and development projects, up to 100% of exposure. But the asset classes are limited. You can invest in townships, housing projects, commercial real estate, and infrastructure. It's interesting that in India, infrastructure vehicles like InvITs are treated like REITs, like real estate investment trusts. And in fact, if we include all the infrastructure investment trusts that securitize road infrastructure or transmission towers, etc., we have over 30 REITs in India already. So it's a pretty decent sized market in that sense. What is restricted in direct equity investment is real estate business. So the government doesn't like foreign players coming in and investing in land or get into property transactions because they're afraid about a bubble being created. The next route is a foreign portfolio investment. So rather than taking direct investment, direct exposure to real estate asset, foreign investors can come through listed equities. They can come in through REITs and InvITs, which by design are listed in India. Now, of course, they can buy corporate bonds and non-convertible debentures. We have two major regulators in this space. SEBI, Securities and Exchange Board of India, is the SEC of India. That takes care of public money. And the Reserve Bank of India is our Federal Reserve Bank, which sort of oversees the debt investments. And if there is more than 10% foreign portfolio investment in India, they may end up recognizing it as a foreign direct investment. So there are more restrictions on foreign direct investment than there are on foreign portfolio investment. But the scale of the projects is so large that even a 10% exposure, staying well within the FPI definition, is quite feasible for foreign investors. Then, of course, there are REITs and InvITs. And here I'm talking about the sponsorship of these entities. So, of course, as a foreign portfolio investor, you can you can invest in the securities of these companies, but as a foreign equity investor, you can also set up your own real estate investment trust or infrastructure investment trust. There are some guidelines like SEC has done in the US on what kind of real estate assets can be securitized or infrastructure assets can be securitized. There are relatively more restrictions on real estate assets and their capital structure in the REIT framework compared to in the infrastructure framework. More interestingly, from 2026, REITs were qualified as equity. Earlier, they were seen as hybrid assets, somewhere between equity and bond. And now they have been classified as equity. That means a lot of mutual funds can take exposure to this equity investment class called REITs. In addition, one can set up funds. They can be private equity funds. They can be hedge funds. So long as the money is not being collected from common public, it can be private. But if there is any public involvement in raising capital, then SEBI has come up with these regulations called alternative investment funds, AIFs. And a great deal of private equity real estate money is coming here through AIF2 route. And there are certain restrictions here, particularly on capital structure and leverage. But there has been substantial activity in the private equity real estate space in India. And then, of course, a relatively less restrictive mode of infusing capital is through debt, and external commercial borrowing is another route. This is primarily encouraged in affordable housing and infrastructure. But to be honest, affordability is an enigma in India. People are debating if anything is affordable for the middle classes nowadays. But so long as the definition of affordable housing is met, the commercial borrowing from foreign players is welcome. And there are a bunch of regulators that foreign investors may have to liaise with. But the Reserve Bank of India, the Securities and Exchange Board of India, the Department of Promotion of Industries, and Ministry of Finance tend to be the most prominent. So the 5 opportunities that I would like to highlight are these, and I will jump straight into these opportunities. Most foreign investors seem to be obsessed with the idea of tier 1 cities. You know, you go to Mumbai, you go to Bangalore, you go to Gurgaon. But the actual transformation is happening in second-tier cities. And yes, the regulation is backwards. It's not as forward as in big cities. But if foreign investors have a good local partner who can strategize on business in the second-tier cities, then the entrepreneurial interests are aligned with the government's interests. And the government has come to realize that our cities are a mess, they're too crowded, and the development needs to be dispersed. And a lot of things have already started happening. The global capability centers are office facilities where, you know, for example, a US bank may want certain things done in their back offices in India. But these are not the same, call centers from 2 decades ago. The GCCs offer very high quality manpower for relatively complex tasks to be done. And 140 new GCCs have already been planned over the next 5 years. This segment is growing by 20 to 30% per year. The leasing has reached an inflection point, but lease levels here are quite high. There is a cost and talent arbitrage. India promises very high quality talent at more affordable costs. And this is the arbitrage that many foreign players want to tap on through the GCC phenomenon. And there has been a policy tailwind. Because of many obvious factors, the economy started showing signs of slowing down. So the government is really trying to push tier 2 cities. The next is infrastructure. So rather than thinking only in terms of offices or malls, real estate investors do have the infrastructure route also to follow. For example, affordable housing segment in many cases would qualify as infrastructure. Similarly, hotels in certain second tier cities could qualify as infrastructure. So real estate has not yet been given the status of an industry, but infrastructure being qualified as infrastructure comes with some advantages. And a foreign investor can set up an infrastructure investment trust, which is very well regulated. And there is a very sophisticated equity and capital market in India. The derivative market is also quite active. And the players in the equity market are quite sophisticated. It's at par with most developed countries, and in many cases, much larger in scale than many Western countries in that sense. So taking the infrastructure investment trust route is another possibility. Foreign investors can buy bonds and, of course, buy equity in these entities, or they can very well set up their own shops. They can set up their own infrastructure investment trusts. The next opportunity to watch for is senior living. And I have a bunch of experts from Japan who have gone through this phase a few decades ago. India is heading to that direction. India will become a country of senior citizens by 2070. But by 2050, it will already have 350 million senior citizens. And let's say 1/3 of that is middle class. We are still talking about over 100 million senior citizens in India. And at least 50 to 75 million senior citizen households. And what our society has come to realize is that in our frenzy for economic growth, we might have turned a blind eye towards the welfare of senior citizens, and people who are active today, a few decades later, will become senior citizens. They will have the purchasing power, they will have the resources, but they don't have the products to buy, particularly in real estate space. So senior housing, specialty care housing is sprouting right now, but in my opinion, this is going to be a burgeoning area. And this is where also a lot of attention needs to come. I mean, there has been 26% growth in the senior living segment of India in recent years. And I don't see any reason why it will slow down significantly in the future. Many experimentations have been done here. Ashiana Housing, Columbia Pacific, Max, Brigade, these are some reputed real estate developers who have tried and tested many different models. Some have worked, some have not worked, but there is room for immense innovation in this space in India. And the next, and surprisingly, is a frontier for residential mortgage-backed security. So if you want to take a debt route, you don't necessarily have to buy bonds of enterprises or come through external commercial borrowing or non-convertible debentures. Now a room has been opened up for RMBS in India. Currently, it's a small market. The annual mortgage issuance is, in India overall is $250 billion. And what has been securitized is hardly, less than 1% of that. I was fortunate enough to participate in the formation of these companies. We were very well aware of the problems that US faced in the global financial crisis, and multiple safeguards have been added here. And an interesting thing about India is that mortgage debt penetration is disproportionately low. So the mortgage market in general is going to grow. And to infuse liquidity in this market, the role of mortgage-backed securities is going to play a substantial, is going to be substantial as well. So this is another place which has not come to the attention of many foreign players. Whether you want to take indirect route or you want to sponsor your own securitization company, both of these are options left on the table. The Reserve Bank of India has come up with regulation. And from my experience of setting this company up for the National Housing Bank, which used to be a regulator of housing finance in India, what I have realized is that the Reserve Bank of India and the Ministry of Finance are quite open to the idea of making this successful. So if an entity faces some challenges, these regulators are willing to talk to them. And mutual funds may consider buying this asset class as well. Because perhaps of the social implications, the default rates in Indian mortgages are very low. I'm currently analyzing 10 million loans issued by a particular bank in India, and the it appears to be a very attractive market. My MBA students at IIM Ahmedabad did some analysis, and we found that this market is huge and substantially less risky given the additional safeguards that the structure has included in itself. Currently, there is a company called RMBS Development Company Limited. You can very well engage with them. I'm very confident that any foreign investor wanting to take exposure to Indian mortgage market may come up with their wish list, and this company may be willing to securitize a very specific type of pool of mortgages for these investors. Or there's of course room for setting up your own securitization vehicle. The next is commercial real estate. For a very long time, foreign money coming to Indian real estate was, to if not majorly, but substantially invested in development of affordable housing. But the commercial real estate market in India has just started to open up, and this is a very attractive market. There is an annual demand of 70 to 75 million square foot of office space in India. This is just 20% of what you see in the US. But I have been studying office leases in India, and this market is quite attractive. There are certain pockets in India where rental rates are at par with many major US office markets. But currently, more than 40% of these spaces are going to global capability centers. The rents are in the range of $1 to $2 per square foot per month, but this can go up to $10 per square foot per month as well, depending on the location. And then, of course, REITs are growing their portfolio very fast. Most of the REITs assets are concentrated in offices, although there are, other assets like hotels and malls as well coming up. But CRE, commercial real estate, is, where a lot of excitement is sort of kicking in the market. In last 6 years, you can see the market capitalization of REITs has multiplied, sixfolds. It has been qualified as equity, and the government is very motivated to promote the REIT structure. And they have come up with some innovations here as well. And one of those innovations is called SM REIT, which is very unique in India. So REITs, when you invest in a REIT, you invest at an enterprise level. You're buying equity or debt exposure to a diversified pool of underlying assets that they own. SM REIT does something different. SM REIT is where you can pick one building or one group of buildings and securitize it as an SM REIT house and float it, list it. And then the same house can go and securitize another asset, individual asset or a group of asset, and float it as a different security. So this is more like a mutual fund house. This is like an, AMC, an asset management company, but focusing on real estate asset, real assets on ground. SEBI has been trying to promote this structure. We have seen some movement here. There is at least one SM REIT that is already working. I feel that some more regulatory overhaul, some regulatory changes may be required in this space, but this is also a very attractive way for foreign investors to gain access to commercial real estate assets in India. So this was all the rosy picture, but as an honest academic, I also have to talk about some of the challenges. There definitely are structuring traps in India. Is usually very difficult to deal with multiple government agencies. Some of them are more transparent than others. There are governments and enforcement issues that we are well aware of. The corruption index in India, the corruption score, we are quite low in the rank. We have very far below, so we can't pretend that there is no corruption in India. There is substantial corruption, and more of that is perhaps in real estate than in many other asset classes. There is always this risk of counterparty. If you partner with a local party, the reputation of the local partner is something that you have to be careful about. And if you think about forex and interest rate parity or purchasing power parity, for a long time until perhaps a couple of years ago, the rupee depletion against dollar was quite stable. It was around 3% per year. But in recent years, especially after the Iran crisis, the exchange rates have suffered substantially. And the Indian currency is depreciating more than one would have expected. I hope that this is a temporary phenomenon, because the secular long-term trend was not very bad. It was actually quite fine. So if foreign investor wants to hedge against currency depreciation risk, perhaps 3 to 4%, perhaps 5% could be a decent margin for that. So that, ladies and gentlemen, is all I had to say. Now I will pass the baton back to Kinoshita-san.
Thank you, Prashant, for a highly informative presentation with full of valuable insights. So now, Matsuo-san, the floor is yours.
Hi. This is Satoshi Matsuo from Genkai Capital. I've been doing this India investment in the last 5 years, but I studied India more than 10 years. Just try to looking for the great growth market, which I found. And as everybody knows, this growth is so great. And the macro story is beautiful. The best thing is this market is demand driven, not the capital driven. If you look at all the other market, the US, Japan, Europe, the money is all over the market and the price of assets so high. But India is different. India is just a demand driven, and I think this trend is stable in the long term. So for us, it's a great market to go. Can I see? Can I share my screen? Okay. I'm gonna skip this kind of a macro story, which Prashant already talked. So I will jump into the characteristic of Indian market. A little bit surprising fact for me. This is kind of a very restricted debt market for real estate. So actually, even in 2006, the Reserve Bank of India prohibited to find a debt financing from the bank to finance the land acquisition. So land acquisition is not able to finance by bank. So in that result of that, to do the real estate deal for the land acquisition, they have to use equity capital. So that is actually, I think this is for prohibiting the bubble of real estate in the market. So that has done in 20 years ago. Then actually one of the key term of this market is 2017. It's called the new regulation kicked in and called the RERA, Real Estate Regulation Act, which is actually brought in a lot of governance to the residential developer. Because before that regulation, anybody can become a developer, and anybody can start, get the approval and start selling and get the money from the buyer. But the greedy developer is not using this capital for this own project for construction, but using to secure the other land. So in the middle of the project, when the sales slow down, the project stopped. And actually between 2010 to 2016, 17, there are a lot of unfinished residential projects all over India. Then Modi government kicked in this new regulation. By this regulation, all the developer have to register this RERA, the project to RERA. And the most striking thing is when you sell the units to the buyer would pay the cash, the cash amount. All the cash, received cash is escrowed managed. So the developer cannot use that money to other projects. Only 30% is allowed to use their own use, but the 70% it has to use for its own construction. After that, the governance of this real estate transaction became so much better. I was told that 80% of a small developer has gone, so only a big developer stays. And this market, after 2020, 2 years of loss from Corona time, but after that, the market really boost, and finances, only finances available for construction from the bank. Although because of that, some non-bank was financing a kind of a real estate land acquisition, but that is also become difficult. That's how central bank is really try to control the bubble of the real estate market. I think it's because even Mr. Modi has to be chosen by election. I think a housing policy is one of the most important policy. He can afford to have a bubble in the market. So that creates a lot of opportunity for us, where the foreign capital can bring the money into quasi-equity or some debt as well. I will show you what kind of a debt financing is happening in India. So this is kind of a illustration of a land acquisition time and also construction to sell the residential. So before the approval, the land acquisition, or actually in case of Mumbai, which we spent a lot of time and we did a lot of deals, vacant land is not available. So most of the project is kind of joint development with a landlord. So at that time, this kind of discussion, because land title issue is the most difficult risk. No foreigner can understand. So that level, no institution, no money will kicks in. This is more like a friends and family, or more like a real estate developer each other, and they try to minimize their money, but they have to spend some. Then at the time of approval, before construction, approval level, they still need some money. Especially in Mumbai, the FSI, the ratio, the given FSI is only like 150% of the land. So all the projects, they have to buy the FSI for a ratio from the municipal government. For that, they need some money, pretty big chunk of money to buying a FSI. So that money we can provide from the fund. They call it alternative fund investment. We provide from the foreign capital. We play this area, and also this is after the approval, the construction starts. Then bank and other NBFC kicks in, and the range of interest rate varies. If it's a listed large developer, they can fetch around 9%. But when we actually, in the last 5 years, we have been lending money to tier 2, tier 3 developer at the rate of between 15 to 18%. So that's a kind of a level of cost of a capital. So that creates a lot of opportunity, and also supply demand. This is whole India residential supply and demand, and this dark blue is a launch, and the light blue is the sales. If you look at this, before this is a RERA time. Before RERA, oversupply, and the market is shrinking. Then after RERA, it is gradually the absorption sales over past year, the launches, and actually this red line is with all India big 7 cities average numbers, not average, the numbers. But today, it's only 1.2 to 1.3 years worth of inventory is in the market. That means The project is sale after the construction starts. So basically, all the construction, project will be sold during the construction period. There's almost no, a stock after completion. So that combined, I think it creates a lot of opportunity. So we have funding from Japan from this time, 2020. So we have funded probably more than 15 projects, construction finance, but there's no delay, nothing. Very, very healthy. We've been looking at the Mumbai market because the largest market in big 6 cities. This is the number of housing units sold. And the same situation with the, this is Mumbai, residential demand and supply. This, this change of the stock is very, very low. Same thing in the Bangalore. So we also do, in Mumbai, there's slum, a lot of slum. Like 25% of land is still covered by slum. But there's a project we do. We actually finance them, only a debt financing. But this slum rehabilitation project is very well thought system, which the authority will help. So once the residential slum residents agreed with the developer, they have to move out. And then after move out, the developer start building the slum rehabilitation houses, and which one they can get for free and get the free housing. But because of this system, the authority gives them a good FSI for free, so they can make a new next to this slum housing, new residential they can build, then they sell it. So we've been financing this type of project after construction starts, and we're charging maybe 15 to 18% of interest on the loan. So my kind of a summary of my presentation is these 5 things. First, India macro, as even Prashant showed, the big number of the macro story is perfect. But the execution is a nightmare. Nightmare is a little bit of a harsh word, but it takes so much time to understand all the regulation, and also finding a good project and finding a good partner. I spent more than 5 years to start the debt fund, and I spent 3-4 years doing this debt fund. I spent 3-4 years to find a equity project partner. Now, from this year, last year, I have doing this joint venture with the Indian developer to build the office building in Mumbai. And also we are just doing the residential equity investment as well. And the second thing is, as already told you, the very strongly restricted finance gives a lot of opportunity for us, either in debt or in equity. The market is growing, so all the good developers spend their own balance sheet as much as possible. So they're always looking for some equity partner or some good debt partner. 3, the land title risk. As I told you before, the land title is a little bit unknown to us. There's so many risks. We cannot believe in the title. So we have to use a title lawyer to check the kind of a 2-3 generation of before the ownership and make it clear this is okay to buy. So no foreigner is taking that risk. That risk belongs to the developer. And 4, I think the local partner is the most important factor. Structure is second, but structure is complicated. And especially Indian people are very smart and logical. They have a lot of structure they can come in. And also we can use, even equity investment, we can use a high interest rate debt as well. So combined with the debt and equity, that kind of structure is very well thought, but it's kind of a logic. But even the structure is great, if the partner cannot be trusted, if the partner betray us, it's nothing works. So I think local partner selection is the most important thing for us. And lastly, I think Prashant already showed, but there is some risk there's some risk of FDI, foreign direct investment rules, as foreigner can buy land, but we are supposed to develop and add value in Indian real estate. If we just buy land and waiting for the value goes up and try to flip it, we will not able to bring the money back. It's a very strong rule for Indian government. So that kind of interesting situation gives, if we know these kind of rules, there's a very, very good opportunity for us to go to do real estate in India. The last pages is just our project we have done. It is already under construction project in Mumbai. This is right now we are fundraising. This is more like a purchase of 20% of unit beforehand with a big discount. And this is also old. There's so many old residential building in Mumbai, like 50 years old, but the location is so great. So we are going to do joint development with the landlord. So if we build this 20-story, 10-story gives to the landlord, and 10-story we're gonna sell, but we don't have to buy land. So that kind of a joint development. This is also same thing. This is two. They call society. Society is the old owners association of the houses. So talking to these two society, and we build this free building for new residential for society, and we build a new office building. Actually, this building we are going to sell as a floor by floor. So strata type will sell. That's how we are going to make the quick return. In general, equity, if you do equity investment, just the gross IRR, we can expect more than 20%. And typically equity the development project takes 4 or 5 years. So roughly we can double the gross rate, double the equity. That's how the market is strong, and wise capital investment makes sense to us. That's it for now for me. Thank you.
Thank you, Matsuo-san. So real estate related financing regulation you explained is quite surprising, because as I'm basically a financier. But having said that, always there's regulation, there's opportunity. And I think you picked up the right one. So now we had two very different but complementary views of the same market. Now we have about 20 minutes for discussion, and I'd like to use it to get behind the slides a little. So let me jump in. So the first question to Prashant. So Prashant, let me start with what's probably on everybody's mind. Many in our audience advise or invest across the US and Europe, but India is still unfamiliar territory for them. So are US and European institutional investors already active in India? And if so, when and how did they come in? And what does their involvement look like today?
Yeah, it's a very interesting question, Kinoshita-san. And short question, but a very long answer. India has been growing as an economy very fast. And at the cost of repeating myself, I would say again that the national level statistics do not portray a realistic picture of investment opportunities. A country with a population of 1.4 billion people, even if a part like 30% of the market is middle class, that means we are talking about one whole American middle class to which real estate products and investments could be targeted at. So yes, there has been a very large number of very sophisticated players from Europe and the US that have been acting in India. If I add up the total asset under management by private equity firms, private equity real estate funds in India that will be larger than the total market capitalization of all listed real estate companies put together. So that is the scale at which private equity real estate has been active in India. And a lot of them are US-based private equity funds. I mean, there are many examples. Like since 2010, nearly 80 billion US dollars has been invested in Indian real estate market. I mean, there's some prominent examples like Blackstone. It bought 50% stake in some asset in Mumbai, some assets in Chennai. They have spent around $1 billion. Brookfield has spent invested more than $4.5 billion. And then both Blackstone and Brookfield have had their own REITs. Blackstone has sponsored many REITs. It sets up one, makes it successful, exits, goes on to set up its next REIT. GIC has invested around 300 million in office properties and in malls. APG has around 300 million of investment in malls. The Canadian Pension Plan, $700 million in logistics, warehouses, industrial parks. Ivanhoe Cambridge, which is now known as CDPQ, has invested nearly $500 million in logistics. Allianz Real Estate. So there are numerous examples. And there's a whole spectrum of the ways in which foreign money has been invested in Indian assets. Some of them are direct investments. Some of them are investments through portfolios. Some of them are through, of course, buying equity stake in listed entities. So yes, Kinoshita-san, there has been a lot of foreign interest in Indian real estate market. And, the experience has been mixed, but overall, there has been a substantial chunk of money pouring in.
And thank you for in-depth explanation. Now, audience can feel more comfortable after listening all the familiar names like Blackstones and Brookfield of the world. So even that explanation is a pretty good takeaway for this webinar, I believe. So next question is to Matsuo-san. Matsuo-san, let me turn to you. So you built a very successful career investing in Japan, one of the safest, most stable real estate market in the world. And then you explained a little bit about why you jumped into India. It's about like a strong growth future. So, but I don't think not only for that. So my question is that what made you go to India? And before your first deal, what worries you the most? And that worry turned out to be justified. So that's my question to Matsuo-san.
Yes, thank you, Kinoshita-san. As I said, the Japan market is very stable, but a lot of money chasing real estate. The cap rate is very tight. Although, yes, the cost of debt is low, but it's edging up. And people are getting a little bit nervous about the future. We actually independent real estate asset management company. We're not backed up by large capital ourselves. So we have to always looking for some new strategy. That's how I start looking into India. And also Japan has so much capital floating in the bank account. Even, I think the amount of capital staying in the bank account is just crazy amount. And we want to we wanted to connect with a very conservative but low yielding capital floating into the market, which needs to grow the infrastructure. Actually, housing, as Prashant said, is a part of the infrastructure, even the office. Everything is very primitive level. So I think this combination with the Japan money, with the Indian real estate growth, I think it's going to be a good combination from Japan at least. And also, Prashant was saying, yes, Indian rupee is depreciating against US dollar steadily, but Japanese yen depreciating unsteadily. but it's going negative direction. So actually, in the last 5 years, our investment from Japan to India, we didn't lose. Actually, even sometimes we get some profit from Indian rupee. So that kind of situation makes me, think about this direction. I think it can be a stable, long-term strategy with the Japanese money, with the demand growth real estate market. The most problematic thing is, as I said before, first time, 10 years ago, I started looking into joint venture with some developer in India, Bangalore. But even though I kind of pointed out and we committed the amount of equity, of joint equity, the project didn't start. The land title issue came up. Some land cannot be bought. Some approval issue came up. And I almost giving up doing this India project with these investors' money, because I cannot predict it's going to happen or not. So that's why I stepped back and finding the structured debt fund and funding the construction project after approval is done and the construction starts. Still, tier 2, tier 3 developer needs the money, even paying 15%. That means their profit, rough profit level is 30 to 40%. Rough profit. So we just participating, 1/3 or 1/4 of it, just financing only 2 years. And after 2 years, even before the sales is finished, the risk is going down. So they are going to refinance us out with the 10% or 11% interest rate debt. That's how it happened.
Thank you, Matsuo-san, for your explanation about your rationale to jump into Indian market. I think this is very true for not only Japanese investor, but very true for US and European investors as well. So next question is also to Matsuo-san. So you said the local partner matters more than the structure. To be honest, that's a striking statement for me and probably for the audience as well. It's because in our markets, in the markets, structure usually is a protection. So I was wondering that how did you actually find and also vet your trustworthy partner, and how made you comfortable trusting them with the investors' money? So I believe you spent a long time and you made, I hope not many mistakes, but you learned the lessons. So if you elaborate a little bit more for that, that would be appreciated.
Yes. Yes, structure in India, as I said before, there is rules, and also there are very flexible structuring debt product in the real estate project. So structure is very creative, and also very we can even take out a lot of a profit as an interest. So that kind of tax planning also included. But so structure is important, yes, for sure it's important. But as I said before, the joint venture partner, if they don't, follow the rules, this, especially equity investment, it is difficult to. We cannot enforce anything from outside of the country. But debt might be a little bit different. But equity joint venture, we really have to choose the right partner. Actually, for that purposes, we have an Indian team. In our company, we create a new joint venture for asset management purposes. So I spent 3-4 years to find the right guy. And I found a very smart, very diligent, very honest guy who is a counterparty of asset management partner in India. So I am also looking for a project, but now the project side and negotiation with a developer is done by my Indian team, and I'm more focused on the Japanese investor side. So by doing this, I tell a lot of investors, we have a great, smart Indian team in India who working to protect for you, not just me. So that kind of Indian to India, and Indian people are very smart. So we have to have a smart Indian team member in our team. That's my kind of strategy.
Thank you, Matsuo-san. I remember the similar, things happened in Japan in around 2000 when the Japanese banking system collapsed and the Japanese bank sold off a lot of non-performing loans. The early on, like foreign investors coming in just as a foreigner. But gradually, they are building up the local platform like Goldman Sachs, Morgan Stanley, JP Morgan, Lone Star of the world, creating the pure local team. And now local teams handling everything locally. So I think you duplicate like similar strategy. That's really impressive. So the next question is to Prashant because I got the insight to how to find out like a trustworthy partner from Matsuo-san, but obviously you're a local guy. So I like to have your insight on that because you're advising the regulator and sitting on the boards. So I hope you have like some systematic advice to find out a trustworthy partner in India.
Yeah, I would love to answer this question. And Matsuo-san is spot on. I mean, finding a local partner is important. And I guess it applies universally. I mean, real estate is a very local business. So, of course, on the capital market side, you're often dealing with the federal government. But on the real asset market side, you are dealing with many other regulators and government entities and also many other intermediaries. There are many pseudo intermediaries in India as well. So I think one common misconception, one common mistake that many Western investors make is to judge talent pool by per capita GDP or economy. I think Matsuo-san said it rightly that if you are looking at India strategically, then find partners also very strategically. These partners need not simply be conduits or tools to achieve some goals. You want to pick their brains, you want to really create room for innovation with the partner. So rather than coming up with an idea and simply getting it executed by a local partner, is a very suboptimal use of the kind of talent pool that India offers. And some of the large players that I've named are playing the other game. So they set up their own shops and offices locally. They hire some of the smartest people uh, and then sit down together to build a strategy on where to invest in and what to invest in. I think that is, in my opinion, slightly provocative opinion, but I think this is the way to go. And that is precisely why Matsuo-san has had a lot of good learnings from India and he knows how to optimize his way forward. But I have some additional suggestions also, like compared to many other countries that I've studied, the corporate governance records in India are surprisingly superior. So if you are talking to a company which is registered, which has a certain scale, you can do your due diligence on the directors of that company, the board of directors and the promoters. And it should not be a very expensive affair to look into their backgrounds and their past records and try to understand the nature of the partner. If the company has been on the face of the earth for a while, then of course, looking at their behavior and performance during the global financial crisis or NBFC crisis that happened in India in 2018-19 or during COVID can also be very telling. And then, of course, the capital alignment. I mean, India by design is cash deficit, and that is what creates room for many foreign investors. So this nature of cash deficit may lead to rent seeking because the local partner knows that you are coming from a foreign land. You don't know the local markets as well as they do. So they may want to take advantage of that situation. So in the term sheets or, in the joint venture structures, it's very important to understand what exactly is going on and, are you getting your fair share of the deal or not? And that is also one reason why you first want to build your presence in this country, bring people who belong to your enterprise, and then start doing joint ventures with, other parties. And, most interestingly, I mean, India has been known for opacity in its land markets. And due diligence is difficult. And for a foreign player, it's indeed a nightmare to do due diligence on, let's say, a land deal. And some of the best people to get this done is banks. There is, for example, State Bank of India is a government public sector bank. HDFC, ICICI, these are commercial banks, but they also have quite decent investment banking wings. So their commercial department has been underwriting loans for many of these developers. I mean, I have some friends in this circle, and they say that sometimes when they are not sure, I mean, when a developer is not very sure about the quality of land title and due diligence, they will just go and borrow a small amount of money against that acquisition. They never needed that money. But in the due diligence, the bank chips in its own resources. Bank has access to information, past records, and they can also help a lot. And if these are big commercial banks, then of course these are relatively closely knit communities. So the investment banking division also can be roped in. So here are my few cents on how to screen for local joint venture partners.
Thank you, Prashant. Always good to have like a good bankers on your side for sure. And I think you both Matsuo and Prashant talked about like a partners, and then well, I'd like to talk about a little bit more about the opportunity locates. It's more like a category asset classes. So Matsuo mentioned like Mumbai development, residential, and renovation of office, and also debt financing as like his opportunities. Well, let me ask you the mirror image question to Prashant. Is there any part of the Indian market where you tell a foreign investor, be careful or don't step in if you come up with something? Please share that with us.
I'm not sure if I have a clear answer to that. There are some well-known problems with Indian real estate markets, and one of them relates to land. So India got its independence from the British colonialism in 1947. And until then, majority of the revenue for the British government was through land. And India is a vast country with very diverse land regulation in different parts of India. So even after independence in 1947, Indian Constitution writers realized that they cannot have a federal level land regulation. So land was left with states. So the regulation of land, land records, land transactions still mostly stays with states, and it varies substantially between one state and another. I mean, what you see in Tamil Nadu and Chennai will not be the same in Mumbai. And this is one area which is very difficult for any international investor to fathom. So you may want to avoid any deals that relates to large scale land acquisition. Uh, and although development rights, no, like they gave in Hudson Yards in New York, India is experimenting with that, and many cities have been very successful. So instead of buying land title outright, you can simply bid for development rights or air rights. Even that uh, cannot be as transparent to international players as they would want. So it's always advisable to get into these deals very carefully. Find the right partner, the right kind of lawyers, Kinoshita-san, and the right kind of counsels. Beyond that, I think in general the regulation is easing, and having a good accounting partner or finance partner is also helpful in interpreting the law and understanding what is more feasible than others. Not all accountants in India would be able to innovate on joint ventures given the set of regulations. So you also have to be careful with what kind of financial advisors and accountants you're partnering with. because some of them are too locally focused. They may not have the broad worldview on that. Some of them do. They are experienced at working with foreign investors, and there are a few firms that can help you with that. But beyond that, I think getting into India is as tricky as getting into any foreign market for that matter, barring some very developed countries.
Thank you, Prashant, for your insight. I see a similarity for bringing like institutional investors into Japan because the land rule is pretty local and it's always tough to understand. So last question. So the clock is ticking. So to Prashant, it's about the future. So as I understand it, today a foreign can invest in development for sure, but they cannot simply jump into an ordinary real estate business the way they would in London or Tokyo. So just like Matsuo-san mentioned, the land banking is not no. So they have to come in indirectly through REITs or portfolio routes and InvITs. Do you see that changing? And I hear that a little bit provocative part. Letting direct investment does more to deepen this market's liquidity than keeping the gate closed. The two big questions.
And it's a very fair ask. I mean, as Matsuo-san said that, if you want foreign developers, foreign players to create new supply, then, you have to give them safer access to land also and ownership and, exit from land. So I haven't had this conversation with regulators in India, so I'm not privy to what they have in their mind. But in general, the philosophy in Indian governments and regulators have been to have foreign money create new supply, at the same time not create any bubble. So they started with a lot of restrictions. I mean, the foreign direct investment in real estate started somewhere around 2005. And they have been receiving feedback over the decades, and they have been gradually releasing, some of the restrictions. So I think in 2014-15, there was a major overhaul of the FDI regulation. And now practically it is possible to directly invest in real estate. I mean, foreign investors can have 100% FDI through automatic route, which means that to be able to acquire assets, they don't have to, run around government offices and seek approvals. This is what they call as automatic approval. In theory, it is there, but there are restrictions. Like here, they don't want to get foreign investors into real estate business, which means, don't get into the business of buying and selling, don't get into speculation, don't flip. They say that when you bring your money here, come stay with us, operate it, make money. And then there could be other routes of exit rather than outright sale. I think I may be wrong, but in general, a foreign direct investor can sell to another foreign direct investor. When they sell to a domestic investor, I think that is where a lot of additional regulations come in. And then many of them have actually exited through the REIT route, like, Blackstone, and there's some other examples where they partnered with a developer. They built the asset. They sponsored a REIT, usually along with the developer. Stayed with the REIT because SEBI regulation requires REIT sponsors to have their stake for a little while, and then they exited. So there are exit routes, but these projects, will happen. Your cash flow projections will be for a few years, like 6-7 years. It cannot be a very short-term thing. The 100% FDI is allowed in townships, in malls, shopping complexes, and business centers. Recently, there has been some lobbying on this front, and there is a likelihood that this will also now open to warehouses and data centers. This is another booming sector that I could have included in the 5 trends in India. And this is also something that foreign investors may want to watch for. But both of you are, quite, I mean, to some extent, right, that it is still not either very popular or very easy for a foreign investor to just come in and acquire an asset. So usually it is still advisable to do it through a partner, because even if there is no land affair involved in it, there may still be complexity. So theoretically it is possible. Practically, it depends. But then there has been like a lot of investment, like 8.5 billion US dollars in a recent couple of decades is actually quite impressive. So in short, I do see a political will to ease in this market up. But yes, the speed is slow. I remain hopeful and optimistic about more foreign investors coming in. I mean, as a student of real estate, I would want the secondary market for commercial real estate to be more liquid. I mean, currently, all these REITs, they develop or acquire assets and then they just sit on them. So they're not even thinking about the idea that there is an arbitrage between the main street and the Wall Street. They are totally focused on, developing, putting the assets on their balance sheet and then playing the capital market game. The other side of the game, where price discovery is happening freely in the real asset markets, is yet to happen. But it is to happen. It is going to happen. And I do see some progress in that direction. And I hope that foreign investors will find this market more attractive, even more attractive going forward.
Thank you, Prashant, for the detailed description of the potential future of the Indian market. It's a vast market, growing market, and I hope the audience today, the CREs, will find out the great business opportunities in India. So thank you, Prashant and Matsuo-san, and please join me in thanking our distinguished panelists.
Thank you, Prashant, Masatoshi, and Yasushi. That was a great overview. To the participants, you must have been able to recognize the reality of the growing India. Each presentation was a really useful guide for anyone looking to examine India. Before closing, I'd like to thank the team that made this international collaboration possible. Larissa Phillips, Cassandra Collier, and RJ Sidlis in Chicago, and Mariko Uchiyama in Tokyo, who worked to coordinate time zones, video formats, and questions to put this together. And also, I'd like to thank to the Council of Real Estate Foundation that provided a grant to help with the cost of bringing all of this together. Lastly, I'd like to say that the APAC chapter of CRE would like to continue to share more Asian Pacific information with you. Until next time, on behalf of the Council of Real Estate, thank you for attending this session of What's Next for Real Estate on the Life Experience. Thank you very much, all.
Thank you. Thank you.